And then at the fiscal year 20 mill rate of 37.32, this has increased revenue to the town of 2.4 million.
So that's an increase off of what number?
The
The-
2.4 total net grand list to the 2.5.
I think you're,
To the two,
So the $65 million change in grand list is from the end of fiscal 20
Right,
to the end of fiscal 21.
right.
Okay.
Say that again?
it's as filed. It's in comparison with prior years, listing as filed.
Listing
Last
as filed.
So that
January.
includes the,
The net
The
grand
above
list
the-
as filed, when we filed it.
is that above the line? The adjustments? In 2020, fiscal year
Includes the
20?
adjustments.
Here? This year? No.
No, it doesn't include the adjustments.
The adjustments, the current adjustments are only 390. That's current, yeah, so.
Can I ask a question?
Sure.
I'm most interested in the 2025-26 year and what's driving the big bump up. Are we projecting some major construction going on in that particular year, that far down the road?
That's a question for Francine. So she's asking that the percent change jumps to 2.11%, or roughly $55 million in 55.
So is your question actually just for the real estate adjustment from development, the $50 million each projection, or?
I think they want to know what's.
Well, when you get all the way down to the bottom of the total net grand list, is this what you're asking, Linda? It jumped.
Yes, but I can't hear anything that she's saying.
Okay, well, we'll have her, it's not amplified, so we'll try to share her answer with you, all
Yeah.
right?
Okay.
Yeah.
Perfect, thanks.
So no, it's based on the current list as filed this year, and my projection, based on the new development that's currently, coming along, scheduled.
Permits and things that we are aware of.
Yes,
So she's saying it's based on projects, Linda, we are aware of, that some of which will not be added to the grand list until as far out as 25, 26? Do we have vision?
exactly. Above, where you see the real estate adjustments from development, the 50 million, that's an estimated in addition to down below. But down the net, total net grand list in bold is my.
Is your projection?
Projection, yes.
And what is that development?
it's $60 million, right?
55.
55, okay. What is that?
It's based on this year and what's going to get added on that's already in progress that hasn't been finalized. So current development is included in the bold area.
So there are, for instance, real estate projects, apartment complexes and the like that have been zoning approved and are in phases.
Yes, and estimating newer residential, miscellaneous permitted work that's going to come through down the line.
Okay, so it's based on your estimate of things that are known and some estimating based on unknowns.
Exactly.
Okay.
And the major unknowns are the 50 million?
Exactly.
And can you say what that is? Because what I'm trying to get at is this real, what service enhancements are we going to need? Like some development has fewer service enhancements and residential has more.
So the only ones that I'm currently aware of right now is the Big Y, all right, is the second phase of the Highcroft, the third phase that's going up right now. We have Sunlight Construction. That's the Cambridge Crossing. We have some more at Carson Way. And, let's see, what was the other stuff that those were pretty much,
Those are the
What I'm-
big ticket
yes.
ones, yeah.
I know there's more, there was estimated, a higher estimation of this in the past, which I brought down quite a bit because,
There's not enough
No.
information, yeah.
so that's why I cut it back.
Thank you. Does that answer your question, Linda?
Yeah, thank you.
Okay.
I have a question.
Yeah, go ahead.
Amy, so for every 0.5% of grand list increase, what does that translate to dollars to offset budgetary expenditures?
0.5% increase?
Yeah.
Well, 0.5% off of what base?
Let's go off the current base.
Okay, so 0.5% of $2 billion is,
2.5 billion, yeah.
well, all right. Let's use a calculator. I'll answer for Amy before she says it. It's all gonna depend on what the mill rate is, of course.
Yes. We can assume the current mill rate.
We will. Uh-oh, my calculator doesn't go that high. I would rely on those numbers. The decimals, I'm not sure I have the decimals in the right place.
But the actual dollar, like, I'm trying to figure out when we give the Board of Selectmen and Education guidance, we're usually looking at the ultimate tax, and what they expend is usually offset by the additional revenue brought in by the grand list, which is not the 50 million, it's the dollars brought in. And that's what I'm trying to get an idea of the scope.
Your calculator worked better than mine, Kevin.
No,
What'd you
I'm
say?
just saying if we go up 2.6% and total increase to the town is
2.5 million.
So roughly 500,000. I don't know if that's.
Yeah, that's
easy
what
to-
I was looking for.
Okay.
So it's about,
Yeah,
just-
500,000.
so every 0.5% increase in the grand list translates to about $500,000
At the current mill rate.
at the current mill rate.
Right.
I'm getting a little bit less than that.
Yeah,
Hold on.
I was rounding.
Oh, all right. We can go with that.
As long as it's within.
Okay, fair enough.
You have a follow-up question?
But I guess my follow-up question is, when we see these grand list numbers, it's not that much additional revenue to offset expenditure growth, is my point. We're still not a winning business yet. But it helps. The 2.6 is good.
I'm just curious, 5 years ago, what do we estimate the increase in the grand list would be for the year 2021?
We have that from what Jamie Rabbit did, but I don't know where that is,
I'm not sure.
I'm just saying it's an imperfect science at best,
for sure.
at very best. But it's encouraging that it's based off of at least some known projects, and because it does take time for those projects to both come into focus, get approved at zoning, get permitted, get financing, get shovels in the ground. I approved the board, Big Y, when I was chairman of the board of zoning commission
Long time
8
ago.
years ago, 6, 7 years ago? At least,
my
right?
time.
6 years ago, probably.
Probably did the sunlight deal too.
Yeah, yeah. So it's, I guess I would have asked the same question Linda did in just a slightly different way. There is a there's variable increases here in this projection period. You know, why only 0.35 and 23, 24 and 2.1, but
Well, that's a reval year too.
So, yeah, so it's,
That's your, yeah.
So we take it you're projecting property values to decrease then? You don't need to answer. Let the record reflect she did not answer.
As you all know, it all depends on what's going to happen, next year. And
Well, yeah,
it's-
the grand
I'm just-
list, this is a simultaneous equation with the mill rate, especially in a period in which there'll be a revalue, right? So,
Yep.
all right.
And just one quick question. Francine is doing some innovative stuff that I wanted to give you the opportunity to share about personal property audits. Can you just speak to what you're doing there and what you're finding?
Yes, actually, I just received one final audit that came through today, and the final bill that will go out will pay, that one audit will pay what we set aside to do these audits.
So we put
Just
aside
one.
$25,000
$25,000.
in the fiscal year 20 budget, and there's one audit that's going to pay for that entire expense.
Oh, what you found from auditing
Yes, just one account so far.
so far,
And there's more to find.
We've just started,
yeah,
so.
all right. Did you get that, Linda?
Barely.
All right.
So I guess that was good
So
timing
we've
to get that
instituted a
today.
policy of,
Yeah.
doing audits, and we set aside a budget to start that process of 25,000. And the very first audit that was done under that new procedure will pay for that $25,000, and there are more potential audit targets.
The others are in
Targets, or is it
progress.
random? How is it determined who gets audited?
I went through the whole listing that we had and tried to pick similar businesses.
So all
So
business,
we're not just,
not personal?
yes, different towns do it different ways. I took that approach for the first time.
Go
So
after the
we couldn't
larger
say we're
papers.
picking on,
Okay.
so.
All right, great. Any other questions? This will be as an important part of our long-range planning as well as the budget session coming up. All right, thank you, Francine. All right, next up is a presentation by Fiduciary Investment Advisors, and we're delighted to have Chris and Tyler with us this evening.
Tablets, no tablets. Tablets, no tablets. I did print it. I just didn't know if you brought them either.
I do have.
Do you guys want them on the tablets, or do you want just the printed copies? We have printed copies as well.
I have the printed copies.
I'm good.
Does anybody need an extra copy? No? Okay. That's all yours.
Good evening, everyone. Good to see folks again. I think we saw some of members of the board about a week or so ago, so this will be old hat. But again, my name's Chris Cashmore from FIA, and I am joined by Tyler Polk. We're both partners at the firm, and we constitute the service team that does work on behalf of the pension plans here in town, the OPEB trust, and the defined contribution plans. You've got a big booklet in front of you. It is certainly our intention to hit the highlights here and just catch you up quickly on the firm and on goings-on with the portfolios and the defined contribution plans. So we'll be tidy with our time, but of course, stop us along the way if there are questions or things that don't resonate, for the group. Page 3 of your handout, we'll get tapped on the shoulder or the wrist if we don't remind you, but there is our annual conference in Newport in June. You're certainly all invited if you're inclined. We can get you more details, but we'll keep you posted on that. It's typically 250, 300 people, and it's been pretty well received and makes for an interesting day and a half of topics and discussion. Firm updates, there's a couple of things. One very obvious that we'll touch on momentarily and two less obvious. On page 4, just in terms of the FIA update at the end of the calendar year, we continue to do everything we've always done. As you know, we have been in existence now for the better part of 13 years. There's about 80 of us based in Windsor with a very large footprint servicing Connecticut municipalities. We've got 35 or 40 Connecticut municipal clients. We advise somewhere on the order of $90 billion and continue to have good client retention and feedback from clients, and kind of all systems go on that front. The little wrinkle on page 6 that I know members of the subcommittee have heard from us already on, but just as a reminder for the broader group, we did announce about 2 weeks ago our intention to merge with a peer firm out of Chicago, DeMayo, Schneider and Associates. You see some of the high-level footprint here. We'll rank squarely in the top 25 largest registered investment advisors in the world. Have close to 180 people. You'll see us operating nationally. DeMayo is a firm we've known personally and professionally for a long, long time. They are a mirror image of us. Fee-only fiduciary advisors to institutional investors like yourselves. Think very similar to us in the sense that client needs and interests are paramount and govern everything we do. And the firms are coming together person for person. So every single employee will continue to be an employee of the combined firm at the end of March. The partners in the two firms will be partners in the combined firm. I think most importantly, for this group, absolutely nothing changes with the way we engage the town. Terms and conditions contractually are the same. We will continue to be a fiduciary advisor. Tyler and I will continue to service your relationship. And it's really business as usual, and the intention is kind of in a thoughtful manner over the course of the next year, 18 months, to bring you even better resources and capabilities over time. But minimum client disruption is absolutely paramount, and we'll introduce those resources in a thoughtful manner. Been very positively received in the marketplace. As you can imagine, we've been out and about with folks for the better part of 2 weeks now, and I think generally people have been very, very receptive to the combination, and we think it gives us a lot of firepower and wherewithal going forward to implement solutions on your behalf.
Can I just get, so there's no redundancy at all?
No. So we do,
I assume you had a general counsel, a head of human resources and so forth?
You know what? That is a great question, and DeMayo formed independently 4 or 5 years ahead of us. So they've been at it a little bit longer in an independent form. They'd gotten to the point where they had dedicated HR resources, dedicated legal counsel, and some of those other things. We were just starting to contemplate those things. We've got folks who dabble in all those areas, but don't specialize in it. So I think what you'll see is when we come together, their kind of footprint and head start in some of that area will kind of backfill for us. And on a combined basis, I think we'll snap together pretty effectively.
So there will be no increased expenses and no savings at all? Somehow it just comes out that there's absolutely no savings and no increased expenses. How did that happen?
Well, there'll be no increased expenses in the sense that, we'll continue to operate person for person. So the aggregate footprint from a cost perspective, this is about growth and kind of ramping up growth and resources. Where there can be benefits to clients, and I failed to mention it, certainly over time, that increased scale will give us the ability, working with investment managers on your behalf and other vendors, to drive expenses and costs for your programs down over time.
Well, you're getting ahead of what my next question was going to be. I would assume that if you have some economy of scale, that there might be some client beneficiaries or benefits down the road.
We think there'll be big client benefits. They're difficult to estimate explicitly right now, but I think that they will be there. And certainly, we'll have more resources and firepower working on your behalf going forward. I've described it to the ad hoc committee, and you've heard this before. We've got 10 researchers in Windsor dedicated solely to evaluating the underlying investment managers and markets and whatnot. On April 1st, we'll have 22 people doing that. So I think you'll see nice scale and capabilities going forward.
Thank you.
Make sense to folks? All right, so let's, if no one objects, we'll proceed quickly here. And again, this is old hat for some folks. Page 8 just sets the table very quickly for what went on in 2019 and what our expectations are for 2020. I'm not going to get into a lot of granularity here. We are operating with the basic premise that the global economy, coronavirus concerns aside, continues to be a fairly solid one, with estimates of global growth, still hovering at 3.25% for 2020. As you all know, central banks around the world continue to offer up a lot in the way of stimulus. There was a Phase 1 deal between China and the U.S. at the end of the calendar year 19, as you know. So we think there's a backdrop going forward into 2020 where we don't have an expectation for a recession to occur just yet. We think we'll have nominal growth economically around the world for the next year. As you'll see momentarily, the numbers were very good in 2019 in terms of capital market returns. We're hard-pressed to think that'll continue into 2020, but we still think it can be a constructive environment for investing with these bouts of volatility that you've seen at the beginning of the year, pop up occasionally through the balance of the next 10 months or so. And as a preview, just to quickly, page 9 gives you returns in the markets for 2019. Focus your attention just on the one-year numbers quickly there, and as advertised, right, it was a pretty darn splendid year in the markets, as you can see. Hard-pressed to think when we sat here with you a year ago, with some of the concerns around global growth and trade friction and other things that we'd get, and the central banks, the Fed in particular, as you know, continuing to notice higher rates of a year ago, that we would get these type of returns. But we had relief on a couple of those fronts. You see the S&P up almost 32%, international equities up, interest rates down, and bond prices up. So hard pressed to have a better year in the markets than that. Folks okay with that? Looks like we're kind of grinding along here. The last reminder before we cut chase to the portfolios, just on pages 13 and 14 of your handout, you'll see there, just as the reminder, for the board, we survey once a year, kind of the landscape actuarially across the state, just to see where peers are and how that is kind of coming out. The town plans are all very well funded, as you know, right? Hovering somewhere, I think the town's at 77% or thereabouts, police is 83, Board of Ed is 75-ish, so I think you're in good standing there. And then you're doing that right with a discount rate of 6 3/4, so you're kind of certainly in good stead from our standpoint when you compare yourself to peers. And I think that's probably enough on that front. Any questions? I'm kind of skipping here just in the interest of time and knowing that a lot of folks have heard this already, but I don't want to do. Sure, Lisa. Yeah.
I think you know, if you remember, I'm a big Warren Buffett, Charlie Munger, and Phil Graham.
I'm sorry?
I'm a big Warren Buffett, Charlie Munger fan. And
Yep.
Munger just came out on CNBC on February 16th, and he noticed that he signaled trouble ahead.
Mm-hmm.
He identified the coronavirus impacting energy and manufacturing deficit, election uncertainty, and the proliferation of, and I'm going to pronounce this wrong, EBITDA, earnings before interest. Yes, thank you. Yeah. EBITDA, as a fake profit metric, and that he felt that the innovation boom is likely to wane. And we just saw recently Apple didn't make revenue this year, so I just wanted to get your thoughts on that. You still maintain the positive outlook.
Yep. So we are late in the cycle, right? We've talked about that. You've heard investors talk about that. You've read it about in the paper. We've had an extraordinarily long uptake economically around the world since the financial crisis. But if you frame that uptake, it's relatively modest from a historical context. And by that, we mean it's been duration, it's been very long. But when you look at aggregate GDP gain around the world, it's relatively modest frame versus other recoveries. So you've got that just as kind of a guidepost. Valuations for capital markets we think are full, but they're not outlandishly overvalued. If you look at domestic multiples, PE ratios is something folks like to look at. We're trading at 18, 19 times in the U.S. and less overseas. If you look at the economic backdrop and the potential for a return to profitability, if you look at estimates, analyst estimates for profitability, corporate profitability, they've stabilized. So we think you've got that. We've got the central bank relief. We've got some gain on the trade front. Kevin and I were talking a little bit on the front end informally. It's really hard to handicap coronavirus, right? And we're going to confess that we're not going to sit here and tell you how we know that's going to play out. We just don't. We have seen informed estimates from Wall Street, Goldman Sachs in particular, that's talked about a 0.2, maybe a 0.3 effect on, percent effect on the global economy as they see things currently. But, I don't know how you prepare or address that. What we've always talked about more holistically with the subcommittee, right, is we know what your expectations are actuarially. We diversify, we're sensitive to costs, we stay disciplined and patient with the markets and let them work on your behalf. And I think over time, that's a recipe to kind of grind along and do what we need to do. And there's going to be invariably bouts of more difficult markets and then much better markets, right? So we're going to see momentarily the pension plan was up, the plans were up 20% last year, right? That's well north of your actuarial expectation. We wouldn't have forecast that at the beginning of last year. That's in fact what happened. This year, we think that, again, the makings are still for decent returns, certainly not those type of returns, but we just don't see the data that would suggest that a recession is imminent and that we've got a little bit more room to go in this.
Thank you.
That, Lisa, help a little bit?
Yes, I was just exercising our fiduciary duty to get that out on the
Good
record.
question. Listen, I hope we're wrong and you get 20% again this year, when we're sitting here a year from now, but it may be a little ambitious, given the tea leaves. All right, I'm probably taking too much time, because I know you're anxious to move on here. Page 16 shows the representation of the three pension plans at the end of the calendar year. Just as a reminder for the board, right, we share allocations here across the three, given the similar return objectives and what we're trying to achieve, and the lineups are the same, and the roster in our estimation is in good working order. We did highlight for the subcommittee when we met about a week ago, there are a couple of managers that have watch designations. Templeton Institutional Foreign Small Company and Van Eck Hard Assets down at the bottom of the exhibit are both on watch from our due diligence perspective. Doesn't require action just yet, just kind of a heightened sense of awareness around those two mandates, and we'll keep everyone apprised if that opinion changes. Otherwise, I think we're in pretty good working order. To my point earlier, right, diversification not only by asset class, but by entity too, right? Lots of different specialty institutional managers engaged on the town's behalf, and that's by design. Page 17 is performance. Just again as a reminder, in the middle of the exhibit, you'll see the one-year number is the one we'll focus on. So the plans net of the manager fees were up about 19%. For the calendar year ending in December, you see the longer-term numbers there, kind of hovering where they are. I think we're in pretty good working order and have had constructive outcomes there. And then I am going to stop on the pension, probably knowing again that I've overextended my welcome. Are there any questions on allocation in the pensions, performance, the individual managers? Anything that doesn't make sense to folks? No? Okay.
Where do you do your fee analysis on the individual?
Yeah, we don't include it, Lisa, here, so and we can share it with you. In the bigger book that we prepare for the ad hoc committee, there's an exhibit where we keep account of what the fees are. The fees today, and your performance is net of these, so if you go back to page 17, those numbers emboldened in the middle of the page there that you see annualized for numbers greater than 1 year, of course, are net of the manager fees. And the manager fees today are about 50 basis points when you do the arithmetic. So about 1/2 of 1% is what's being charged across the totality of the portfolios. And they're netted in these figures.
Okay.
Make sense?
Can you just email that to our
Sure.
board? Thank you.
Yeah, sure. We can share that with you. All right, let me go quickly here. So if we switch gears quickly to page 23, the other asset pool that we attend to, at least I attend to and work with you on directly, is the OPEB Trust. And you see on page 23, obviously the town has done great work just aggregating an investment pool here, right? You're, as we tell you every year, way ahead of many of your peers in addressing this and putting meaningful money to work. So at the end of December, just a little north of $18 million of invested assets. The protocols or the outcome here is a little bit different. In working with the ad hoc committee, you'll note here that the portfolio is entirely indexed today. So there is no active management. We just have a simple expression that's diversified by asset class, but using ETFs. And Mr. Prell is smiling because he is a big advocate of indexing, and we know that, and want to be sensitive to that. We had done some work with the subcommittee, Simsbury Bank, bought by Liberty Bank, now Raymond James, and we had done some work around that and potential alternative custodian bank solutions, moving away from Simsbury Bank. We worked with Amy on kind of repapering the relationship, so now you reside with Liberty Bank and the Raymond James framework, if you will. But the larger allocation here kind of continues to ring true for what you're trying to achieve. And if you turn to page 24, you'll see in the exhibit just the net numbers for the OPEB trust through time. And so you can see it had a fairly splendid 2019 as well, up 19.5%. Fees here are about 20 basis points in an all-index format if you do and calculate things on a look-through basis.
How does that come?
And that is an admittedly quick update, but I don't.
Chris, the only question I have
Oh,
is,
sure.
The correlation, the pension versus OPEB to the market, are they correlated similar?
Yeah, I think they would, you mean just in terms of how they would react?
What's the risk, and do they have the same risk in both portfolios?
It's very close statistically, right, because the larger allocations are not all that far apart, right? So that larger commitment to fixed income, domestic, international, will drive the bulk of that kind of exposure, if you will, to the market.
Right.
Where you'll have a little bit of differential in the pension plans is any tracking error you may get out of the active manager stances.
Okay.
Right, that's different than the intention in the OPEB that's all indexed currently. So that could maybe tweak it a little bit, but by and large, they're very similar.
Thank you.
Are you seeing a difference in, what I'm trying to get is, why aren't we doing all index? We feel that active management is helpful in pensions, but not in OPEB? What's the
No,
thinking?
so we've talked about this a lot with the subcommittee, Lisa. I think there's an ongoing dialogue with the subcommittee around potentially over time implicating some active management in the OPEB trust. But for the time being, I think the comfort level has kind of fallen in the camp of just keep that kind of in an accumulating mode. It's kind of very simple, and we're just trying to grow this thing through time. And we'll tackle that at some point, in the not-too-distant future. So it's a dialogue we have regularly with the group, and push comes to shove.
Yeah, I don't want to put words in her mouth, but
Right.
I think she was actually asking the opposite
Yes.
question. How come we're not going away from it, active management? Was that your question? I didn't
Yeah,
want-
Why
no, you
wouldn't we
look at the
consider
results,
index
right.
for the?
Listen, we would, the last 5 to 7 years, given what central banks have done with stimulus, has created, in our humble estimation, an artificiality in capital market returns that's not likely to persist going forward. We think in times of stress, in times of volatility, all boats won't float the way they have over the last several years. Indexing over the last 5 to 7 years has been the winning hand. And if you want to go even further with it, it's been large cap U.S. equities and plain vanilla fixed income has been the ultimate winning hand. In an institutional setting with portfolios of your size and complexity, we continue to advocate for a mix of active and indexing. We didn't highlight it in the pension plans, right? But you have meaningful indexing in the pension plans as well. We're trying to mix and match this a little bit and find areas, fixed income, international equities, where there's histories longer term of incremental return net of fees. Again, you don't see it over the last 5 or 7 years because indexing has been impossible to beat. So we would, if you pressed us, we would continue to think that mix of active and indexing is appropriate. We just haven't gotten there yet in the OPEB trust. For the time being, we've continued with an all-index framework.
Kevin, what are your thoughts?
I disagree, right? I mean, to Lisa's point, she's an active Warren Buffett fan, and Buffett made a bet in '09. He bought the SPY up against a hedge fund who actively managed it, and he outperformed it, and that's 11 years ago. So, but, I mean, that's a conversation for, the committee to kind of review.
what are the savings if, like, you switched to all index and had the fee savings? What would that be for?
I'd have to run through, like, so if you look at the comparative, right, it would probably be, in this comparison, we could index even cheaper than in the OPEB trust. So it would probably be a 35 basis point savings in fees year over year, Lisa, if you were all indexed. About that, I'm giving you an estimate, honestly, we'd have to go back and calculate it. So you take, you know, 1/3% on we get a lot of pushback on this, and it's completely valid and understood. But as we sit here tonight, in 2020, for the next 5 years and the next 10 years, we do think you will see a more balanced representation of active management being more competitive with indexing, which has certainly not been the case, as we all well know, for the last 5 to 7 years. You can't beat indexing the last 5 or 7 years. We just don't think that's a proposition that exists forever, with one exception, and you've got it expressed in your pension programs today, large cap U.S. equities. That's an area where we just think you stay indexed forever, and you've got that expression in your programs today.
I feel compelled to speak up for the asset managers of the world, but I think that, some balance is appropriate over time. It shouldn't be about what it costs, it should be about what the net return is from the cost. And so that's why we pay the firm to help us pick the goods and the bads. And there's nothing wild and crazy in the asset manager asset classes that we're going after. Just somebody that over time has been able to demonstrate the ability to earn that return that more than covers their increased costs. So I think it should continue to ask for their guidance and continue to push for the things that we think are appropriate, like the
It appears to
conversation
me
we
to be
have.
a high-class problem. I mean,
Yeah.
we've gone heavily in index, and it's worked well, and we're retaining the asset management option to a small degree, at least, to hedge our prospects for the future. So
Exactly. It's good balance.
I think on balance, when you bring all those fiduciary assets under one hood, and you look at the investment management fee profile versus peers for what that's worth, kind of on an aggregated basis, you're clearly running inside most of your peers from a kind of a born investment expense perspective, if that makes sense, right? Both by virtue of the amount you've got committed in the pension plans, and then moreover from the full indexed approach in the OPEB trust.
Okay. Let's keep going. You want to touch on anything else, Chris? Or
I, Mr. Chairman, am done. Mr. Polk is going to bring you through the DC. If no one objects, I am on my way across the river for another client meeting.
Good.
I appreciate
you,
your
Chris.
time.
Thank you for
Thank you
coming.
for the good questions.
Thank you.
You're on your own, Tyler.
That's okay. So Tyler Polk, I'm the consultant on the DC plan, and I'll take you through the defined contribution plans. Just a reminder, we are doing a RFQ, request for qualification, with respect to the record-keeping product. We've done this project with some peer cities and towns, and feel that it's gotten some really good results from a services standpoint and a fee structure standpoint, and we've gotten some really good, about, I'd say, 7 responses to the RFQ. So we expect some pretty good results from a record-keeping standpoint for fees, and of course, the services that go to town employees. If you want to go to quickly on page 29, just give you a regulatory update, given that it was one of the bigger acts passed since essentially ERISA. But the Secure Act was passed into law on December 20th. Secure is setting every community up for retirement enhancement, so I'm sure some intern got a big reward for figuring that one out. But how it impacts the plan or the Simsbury town is that there may be some guidance on selection and evaluation of annuity products, so we may see more of those in the marketplace, not necessarily offer in the plan. Plans are now required to show an income projection on statements, and so we're looking for more guidance from the DOL on how to show that projection. but we're going to see those on statements. Most record keepers like MassMutual provide that already, but it'll be standardized across all statements for participants. And then finally, the required minimum distribution is moving from 70.5 to 72. And that's applicable now as of the first of the year. So this is really the biggest impacts. There's another permission to allow for people who are having births or adoptions to take out distributions penalty-free. Right now, it would cost 10% to take out distribution if you don't fall within that 59.5 plus. But that would be an optional provision that could be addressed down the road. I think right now, the industry is still looking on guidance on how to administer that. So more to come on that. If there's no questions on the Secure Act, I'll briefly touch on 31. This is just a reminder of how our governance calendar looks. From a fiduciary standpoint, we like to touch on all these things. This current quarter is a review of the investments, and we show you what the investments look like on 34. Really briefly on 33, just an idea on how we build out investment menus and how we think and approach investment menus from a behavioral finance standpoint. We want to keep the investment menu for the town employees simple. We want to offer both active and passive investment options, or active and index investment options, so that people can have both the ability to invest in funds that try to beat the index and the low-cost index options. And then, of course, we value the target date funds or the glide path that are associated with that target date funds, because we do believe that inertia is very strong in the industry. People don't tend to do anything, and so if we put something or build a product around the fact that someone may invest in this and over time keep it there, this will change and decrease in risk as they approach retirement. So that's how we build an investment menu. The investment menu that we've implemented starts on page 34. And you get an idea of where the money is invested across the different investment options. Again, as you can see, the suite of T. Rowe Price retirement funds are illustrated as the largest asset gatherer. What we're showing you is the percentage of 12-month contributions into those investment options and the number of individuals invested in that fund. And so you can see a big portion of the T. Rowe Price target funds and a big portion in the general account, or that stable value option as well. What we'll want to do, we are and have been limited by the product, and I think this RFQ will allow for the ability to offer different index options. Right now, we're limited to sort of BNY Mellon options. I think when you do this, the industry is now in a place where most products are open architecture, where we can get access to any different investment option, and you don't have that right now with the product you're in. And so we'll be able to get access to Vanguard or Fidelity index options that are much lower in fees given what you're currently paying for. And then right now you're limited to the 10 target date fund options in the 10-year. Typically, we want to give access to the every 5-year target date funds as well. And of course, we'd be able to give people the ability to invest in indexing through international. So I think the RFQ project will bring about some improvements to the investment menu as well. Without going into too much detail, we spend a little time on the qualitative details of the T. Rowe Price target date funds, given that they're so heavily invested on 35 and into 36. And we show you visually how the glide path, when I mentioned glide path, that's just the decrease in stocks and increase in bonds over time. And you can see that visually on 37, the T. Rowe Price funds versus all of the other targeted funds in the industry. Again, T. Rowe Price believes a little bit more in the risk of inflation and the risk of longevity, living a long life, healthy life in retirement and outliving your funds. So they believe in higher equity positions. So that's the basis behind their glide path, and they feel that they should be a little bit higher in equity versus some of their peers. And then, of course, on 38, we just show you the risk to reward. Obviously, if T. Rowe Price is taking a little bit more risk, are they getting the reward for that risk? And you can see further on the vertical axis of each of those vintages that we're showing you there, the better return, and T. Rowe Price is sort of on the top of that. So performing very well given the risk that they're taking over the last 5 years. If there's no questions on 40, 41 into 42 are the balances. As a whole, the defined contribution plan is about 13 million in assets. Obviously a big portion of the new money going to the targeting funds, but also a big portion in that general account as well. And a reminder, the general account of the 457 is in the old Hartford annuity product that is that guaranteed 4%, but is for the rest of the assets fairly high in cost from a record-keeping standpoint. So that's part of the rationale behind the project. So
How would that compare with an in-plan annuity cost?
So,
I haven't looked at that
so there are products out there like TIA annuity that guarantees at around 3%. The liquidity constraints become a challenge. You typically, for those particular products, you can't get the money out over
Right.
It's 10 years.
10 installments, 9 years in a day. So it's very competitive. The challenge with the Mass Mutual product is that they're charging the whole for the use of that product. And it's very limited based on the types of investment options you can offer for everyone else who's not in that general account. But again, you're not going to get 4% guarantee anywhere.
Ever, right.
So that's been the challenge,
Yeah,
and that's
right.
also what we're including in the RFQ, creative ways on what types of stable value products you can offer, what kind of general account products you can offer. Some record keepers can actually taper those products, so they can provide a 3% and then it'll taper down to something that's more competitive, where we're seeing rates more like 2.25%.
That makes sense.
Nothing, typically the minimums are around 1.5% to 1%, nothing like a 4% guarantee. This is the old Hartford product that was then sold to Mass Mutual. And we've asked, and every time we look at the record-keeping costs, and they've been slightly higher than what we see from a benchmarking standpoint. And, Mass Mutual has agreed to that, but said, sure, get rid of the 4% guarantee product. So, would have been a back and forth challenge with the internal committee. And we'll be able to address it during the RFQ process.
Maria, there's been, we've had a bunch of new hires, many unaffiliated, and I know it used to be a priority of the Board of Selectmen. I don't know if it still is, to transition new hires to defined contribution away from pension. And I was wondering if you had an update on how many of that has been done. And I know you're entering union negotiations with, I think, 5 unions. Is that going to be a topic of discussion or no?
Sure. So, 2 of our union groups, new hires, they only have the DC plan that they can enter into for the pension option. 3 of our groups, they have the option of the DB or the DC plan. However, the employee contribution to the DB plan is quite substantial. So we are finding that a number of employees are making the choice to go into the DC plan, but some are still picking the DB plan, even with that very high employee contribution. Our only group right now that is a DB only is police. We are currently arbitrating the police pension contract.
And of the unaffiliated, I think you hired 6 new people. Are they all defined contribution?
They
or
have an
pension?
option. They have an option of entering the DB or DC. And again, we've had some that have chosen DC and some that have chosen DB.
So we're still hiring non-union people that have a choice to take the defined benefit plan?
That's correct. But it's also a very small group of employees. It's only about 11 employees of our 170 full-time employees.
Is there a reason we did that?
We have not revisited that, at least since I have been here.
Should we?
Yes.
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 We could look at it.
I'm surprised by that, because I thought 4 years ago we made it clear that
LDC.
new hires should be other than under contractual union, so we need to develop, or what policy does that come under?
That's under
For
the
us.
Board of Selectmen.
Yeah.
But we can certainly convey a concern.
Yeah. Okay, all right.
Performance funds are maintained with the exception of one fund, which is on wash, which is more qualitative.
The MFS Value Fund is, there was an announced transition of Steve Gorham, who's been the lead PM. He'll be transitioning to a different position at MFS over the end of the year. We're just going to continue to watch that, so. No recommendations for change.
Linda, do you have questions for Tyler? Chris has left the building, but were you able to get?
Nope.
All right.
Sorry, I had to find my mute button. No, I'm fine, thanks.
Great, okay, good. Thank you.
Thank you.
Appreciate it.
Appreciate
Anything that Derek or Kevin you want to add, or questions, or?
No, I think that's good. I mean, I think we're continuing to go through do we have to vote on the RFQ or?
Not right now.
Not right now?
Tyler's set to present to us mid-March.
Yep.
Mid-March? Okay.
All right, great, thank you very much. Okay. Next up is a presentation by Bloom Shapiro, Nicoletta, and team. Welcome.
We have a printout of the presentation.
Okay,
And just
Thank you.
thank you. School flip chart.
No, I'm.
Linda, we were handed a flip book, but we'll get you a copy electronically.
Just so we don't have.
Yeah, I'm
to
actually
repeat
watching you on FCTV.
You're the only one.
I saw it.
Yeah, a little bit. Go
Good
ahead.
evening. I'm Nicoletta McTighe, partner in charge of the audit. And with me is Jess Anscoff, and she's the manager in charge of the audit. So as part of the audit, we issued several reports, so I figured I'll put something together in this short presentation, what I was planning to cover. But you can interrupt me anytime if you have any questions, and in the end, if you have already prepared questions based on your review of the CAFR, I can answer them.
Can I just ask, what was the scope of the audit, just for start? This is my first time through, so what did you audit?
So we audit the financial statements of the town, which is bound in a big report that is Comprehensive Annual Financial Report, or as we refer to CAFR. We audited the federal assistance, so we perform a federal single audit. We audited the state assistance, so that's perform a state single audit. And we did, in addition to the financial statement, the federal single audit, state single audit, and agreed upon procedures for the Board of Education report that they submit to the State Department of Education, and it's called EFS reporting. I did not include that report in my presentation. It's not an audit, it's agreed upon procedure, so the State Department of Education basically tells us which steps to follow as far as that filing that the Board of Education does with the State Department of Education.
Thank you.
In my presentation, the first item of the of the presentation is engagement scope and reporting. So I guess I can skip that part. Now, the financial statements are responsibility of the management. So management is responsible to prepare the financial statements that are going to be audited. And in addition to that, management is responsible to design the internal controls over financial reporting and implement those internal controls over financial reporting in order to ensure that the financial statements are free from material misstatements, whether due to error or fraud. So material misstatement is the key word when we talk about financial statements. We are not talking about to the dollar misstatements, but material financial misstatements. Our responsibilities as auditors are to do the audit and to give an opinion on whether or not these financial statements are free of material misstatements. So to give a reasonable assurance whether or not these financial statements are free of material misstatements. So we are responsible to plan the audit and perform the audit, and based on our audit, then give an opinion on the financial statements. So when it comes to opinion, it's more than one opinion. We say give opinions on the financial statement. Each opinion unit has its own his own opinion. So there are several opinions that are included in the financial statement. Them being general fund is always an opinion on the financial statements. Sewer use fund, Board of Ed program funds, capital projects funds, and and all the other remaining funds make up together another opinion unit. So based on our audit that we perform on the financial statements, we give an unmodified opinion on all these opinion units, which means that it's a clean opinion, which is the highest form of the opinion that you could get in the financial statements. I'm going to skip over the last two bullets there, federal single audit, state single audit. I'll talk later on about, I have another slide on that. So in addition to expressing opinion on the financial statements, we issue a report that is the internal control over financial reporting, or yellow book report, or report as required by government auditing standard. You'll see all these different references on that report. The report has two parts. One is the internal controls over financial reporting, and the other part is compliance with laws and regulation. We do not give an opinion on the internal controls, but if, as a result of our audit work we come across any significant deficiencies or material weaknesses, that's where those findings will be reported. Based on our audit work, we did not identify any significant deficiencies or material weaknesses over financial reporting as a whole, and we did not have any findings as far as the compliance with laws and regulations go. So that report was clean. On page 6 of that printout there, I included comparatives on the governmental activities. So that is like the Exhibit 1 of the financial statements in the CAFR. It's prepared on full accrual basis of accounting and includes all the funds of the town, general funds, special revenue funds, capital project funds, internal service funds, with exception of the trust and agency funds, which will be the OPEB, pension trust fund, and agency funds that are not included in the governmental activities section of the report. As you can see on that page, the total net position of the town decreased slightly from $110.8 million down to $109.8 million, so it was less than $1 million decrease on the net position of the town. As noticeable, the capital assets of the town decreased from $136.4 million to $131.7 million. That was mostly due to a reduction on the, or the increase rather, on the capitalization threshold of the capital assets for the town. So that it's not that we lost a lot of assets, just that and now only the ones above certain threshold are included as capital assets of the town. But overall, the change in the net position was less than $1 million. On slide 7, just took a picture of the fund financial statements, which will be the exhibit for statement of revenues, expenditures, and change in fund balances. As you can see there, the total governmental funds fund balance at year end was $35.1 million, which was about $8.3 million increase from the prior year. Included in that $35.1 million is the general fund balance of $17.1 million, and general fund balance increased $315,000 comparison to prior year. So the first column there on the general fund. Included in that $17.1 million of fund balance is an unassigned fund balance of $16.5 million for the general fund. If there are no questions on any of these columns, I'll move to the next slide. On the next slide, I summarized some general fund budget highlights. Budgetary revenues were $571,000 greater than budget, and if you want to look at, I reference the pages there. Property tax revenue was $887,000 over budget, and property tax collections reflected 99.4% of the current levy, which was similar to what was in the prior year. Budgetary expenditures were $5,000 less than the final amended budget, and during the year there were supplementary budgetary appropriations of $2.8 million that were approved, of which about $1 million were made from additional revenues and $1.8 million from general fund unappropriated and unencumbered surplus.
So Amy, can you just explain that?
The last part?
Yes.
So the supplemental appropriations, I don't know if we did any mid-year, but I know we did a bunch of year-end transfers. So we had significant savings during the year. We had our bond premium, we had the increase in the tax collections, we had some storm money that came in unexpectedly. So all of that stuff at the end of the year, we did transfers out. So our increase to fund balance should have been, I think, over $2 million. But we did those supplemental appropriations to move the money out into the capital reserve fund. And we did a contribution to the health insurance fund.
That's the $1 million.
Right.
Yeah, okay. Thank you.
On slide 9 there, I summarized the pension and OPEB statements. So it's a statement of changes in net position. As you can see, the total fiduciary funds, pension trust fund and other post-employment benefit, or as we refer to OPEB, the net position at year end is $83 million, which was an increase of 3.5 or $3.6 million. Included in that $83 million is the net position of $66.4 million for the pension trust fund and $16.7 million for the OPEB trust fund.
I had a question.
Yeah.
In the CAFR, it references you're using an 8% pension investment assumption. Is that just a misstatement in the CAFR, or what pension investment assumption are you getting to funding?
The 8% is probably what you're referring to is the discount rate that's used by the state for the teachers' retirement plan.
On page 56 of the CAFR, is that right?
Correct.
Okay. So what assumption are you using when you calculate our percent funded?
So for the town is the discount rate, it was 6.75%, and that was down by, from 7% in the prior year.
Perfect. Perfect.
So the teacher's retirement is measured 1 year prior to year end, so the measurement date was June 30th, 2018, and the state still had the 8% for that year. The liability that you see on that page is actually the liability in state's books, but it's on behalf of the town of Simsbury. So the $111 million that you see on page 56 is the liability in state's books, but it's for the retirees of teachers that are retired from the town of Simsbury.
So the liabilities are understated, most likely.
The liability, total liability is in the billions, so it's over $1 billion for the state. But what belongs to the state on your behalf is $111 million as of June 30th, 2019, which was measured on June 30th, 2018.
Right.
Because they are 1 year behind. But to answer your question, their discount rate is quite higher than what the town is using, and the town went down 0.25%.
The state has adjusted that since, right?
Correct. So for fiscal year June 30th, 2020, the measurement date for that plan is going to be June 30th, 19, and it's gone down.
To what?
I think it's 7%, but
wow.
don't quote me on that. Yeah.
It's a big jump.
That is a big jump.
Yeah, so their liability is quite high. On the next page, I summarize the patient liability so that's the liability of the town for all combined for 3 plans is $19.9 million, and combined all funds are 76.92% funded. But if we break it down by each plan, the general government is 75.59% funded, police is 82.14% funded, and Board of Education is 74.75% funded. And you can see those
I'm
numbers.
sorry, where is that?
She's just reading
Oh,
ours.
They are on page 50. So if
The
you
average
go on
out
page
is
50
76.92.
of the CAFR, you'll see the funding levels for all three.
oh, yeah.
On the slide, I just put the combined funded, but I referenced the page.
Okay.
50. And as far as the OPEB liability goes, the town has a liability of $6.5 million, and that will be on page 60. The plan is 73.41% funded, which I would say is quite rare to be that high. most towns, or at least that I see around the state, are not in the 70% when it comes to the OPEB plans funded. I see plans in the 5%, 20%, 30%, in the 70% range is you are in a good place right now.
How are they going to cover their expenses?
That's a good question.
Out of their operating budget.
Yeah, so, yeah, I just wanted to point out that this number, comparative to even surrounding towns, is quite good. So that was the highlight I wanted to bring regarding financial statement CAFR. I could go on and talk about federal and state single audit, or I can take questions regarding CAFR if you had any prepared questions ahead of time.
A question. I have a question.
Go ahead.
If you go to page 76 and 77, it shows pension liability as a percentage of payroll, 113%. So are we paying more in benefits than we are in salary?
Page 70.
6. Town's net
So
pension liability is a
Liability
percentage.
is not expenditures.
Yeah. Oh, that's liability.
That's liability.
Okay.
So the higher the liability goes year over year, this number will increase if the covered payroll stays similar year over year, which was the case.
Got it.
It's just a coincidence of numbers.
Yes.
I had the same question, but I couldn't really understand the end. Can you, somebody closer to the phone?
Rob.
explain that?
So the 113% is the result of dividing the pension liability, which is now $8 million, by the amount of the covered payroll. It's not saying that we pay out $8 million. It's,
Oh, okay.
it says that our calculated liability for the pension is $8 million. There's two different kinds of numbers that are about the same size.
Yeah, so the higher the liability year over year, if your payroll stays similar year over year, that percentage will increase. Even nothing else changes, just because the liability goes up, that percentage of the covered payroll will go up.
Okay.
A question on the
Sure.
actuarial assumptions. There were new mortality tables that came out.
Correct.
So were they used here, or are these old mortality tables?
So to see what mortality tables were used, go on RSI 5, A, B, and C. So it's page 79.
Just more curious as to whether the latest mortality tables were used.
They continued using the RP 2000.
Okay.
They
Okay.
are not the most recent. We actually have had discussions with all the major actuaries in the state regarding using those tables. So for fiscal year ended June 30th, 19, not everybody used all the new mortality tables based on what fitted the client the best. So they continue.
And just going back to that number, the 113%, on all of these tables, it went up from somewhere in the 90s to over 100. Is that a result of dropping the discount rate from 7 to 675?
That was the major reason.
Right, so the liability went up
Got it.
as opposed to
And it will
the,
go up if we drop it again.
yes, it will,
Okay.
probably on the same order of magnitude.
Okay. So that explains on page 50 why the net pension liability went up $2 million from last year too.
Yeah, whether the pension increased? Yeah.
not really sure I understand your question, Linda, because on page 50, there's no comparison one year to the next.
Right, but I always look at last year's CAFR when I'm looking
Oh.
at this year's CAFR, so I do the comparison, it's not on the page.
Okay.
They go up
All right, thank
If
you.
you want to see,
3.2 million, actually.
Yeah, okay.
if you want to see the change year over year, you can see on pages 52 and 53, you see what the net pension liability was at the beginning of the year versus the end of the year. So for general government was $6.6 million, it went up to $8 million. Police went up from $3.1 million to $3.8 million, and Board of Education from $6.9 million to $8 million. And all the pluses and minuses on those tables will tell you what factors went into that increase for each fund.
Is your recommendation still 6.5% for our pension investment assumption?
We actually do not give those kind of
You don't?
recommendations. We don't.
Okay, about from the actuaries. Do we have an actuary's recommendation on that?
Yes, they came into the pension subcommittee about a year ago,
Yeah.
and it
so-
was their so about, a year and a half ago, because that's why we went from 7 to 6 3/4,
To shoot for 6.5.
right?
So that's still the recommendation, okay.
We cannot recommend those numbers as auditors, otherwise we impair our independence.
Got it.
If there are no more questions on the CAFR, on the next slide, which is page 11, I summarized both the state and federal single audit in one slide, just to make it easy to follow. So both of them, the state and federal single audit reports are kind of format-wise the same. They have a report that's internal control over major programs and then compliance on, and the report on the compliance on the major programs, and both of them have the yellow book report that I mentioned initially. That's a report on internal controls over financial reporting as a whole. As far as the federal single audit goes, the town expended $2.2 million in federal awards. We tested special education cluster, which was $1.1 million, where we are required to test a minimum of 20% of the federal expenditures for the year. We expressed an unmodified or clean opinion on compliance on this major program that we tested, and we identified one deficiency related to procurement on the special education cluster program. So uniform guidance required as of July 1, 2018, all entities that are receiving federal assistance to update their procurement policy and include, there is a slew of things that have to be included in the written procurement policy. As part of the audit, we looked at the procurement policy for the Board of Education, and we identified some items that were not included. They are required to be included in the written procurement policy, but that were not included. So we identified that as a significant deficiency on the control over just this major program. I mean, the management can speak to where the status is of that finding, but we identified that.
So just to clarify, this was a Board of Education policy, this was not a town policy. The town policy, we updated when we found out from the auditors that this was going to be a requirement for the federal grants. So the town policy is in compliance, it's the Board of Education policy that is not in compliance. So as soon as we received notification from the auditors that it didn't pass, I put together a draft policy for the Board of Education that is ready to go before their policies committee in the spring to have the policy updated to include the federal language, and then we'll be in compliance for the next audit.
Do you know if the Board of Ed missed out on any grants for not having the appropriate language?
They did not miss out on any previously, so this would impact their grants going forward. And I think it's pretty safe to say that there were other communities that received this deficiency, and we don't think that there's going to be any impact, but obviously we don't know.
So the important part that I want to emphasize is that the report on compliance is clean. So there were no findings. We did not modify our opinion on compliance. That means that even though the procurement policy was not updated to the fullest, they did not miss out on complying with all the requirements of the program. So It is a finding, but it's not a severe finding in the sense that that will prevent the Board of Education to get the same grant again next year.
Understood.
I actually have some other clients that had that finding, and already the communication from the federal agencies is done, and they showed the new draft, the new report, and the finding is remediated, basically. So, and since the special education cluster is a pass-through grant through the State Department of Education, you're probably not going to receive a communication from the federal government. You would have received a communication from federal government only if it was a direct grant. In this case, the State Department of Education will probably follow up with you guys and say, what have you done so far, and have you remediated the finding or not? And if the finding is remediated, then it just stays there.
So that's not under your purview to come back and acknowledge that this change has happened?
We are going to come next year and ask the questions, have you done it? And we are going to look at it.
But it's a
and then-
year out.
Year out, yes.
Yeah, okay.
And there is a report that goes to the state that said that is bound together with a package that goes to the state that says, yes, it is remediated.
Gotcha.
So that's our responsibility.
Okay.
The Board of Education responsibility is to do the new procurement, to update the procurement policy. Our responsibility is to say, yes, truly they did it. They're good now, no issues anymore.
When you audit other towns, do you generally see 2 procurement policies for the Board of Ed in town, or is there one, or?
I can't say generally, but I see both situations where the town and the Board of Education have separate policies, and I see a lot that have the same policy, they follow the same policy. I don't have a percentage 50-50, but I see both situations.
Just, although I'm not sure who to ask this to, but just going forward, what processes do we have in place to prevent this from happening again? And that may not be something I can ask you, but maybe one day I will be asking you if this change becomes permanent.
Hopefully federal government doesn't ask for more
I just do what they
changes.
tell me to do. They said to put it in, I put it in.
But you also let the Board of Ed know that as well, right?
Correct, yeah.
So, okay.
We wouldn't take sides, notify one and not
Right.
the other.
I wanted to make sure it wasn't on our end that we didn't communicate, or was it?
We actually had those communications a couple of years in a row because initially that uniform guidance requirement was going to be applicable for a prior fiscal year, but because of a lot of changes needed to be done to procurement policies, the federal government actually pushed it twice, I believe, 6 months and 6 months, so that was like one full year.
Okay?
And the state single audit, state awards expended $10 million, of which only $2.8 million was subject to single audit, so it was non-exempt. We tested 3 major programs: Open Choice Early Beginnings, and a Library Lower Level Improvements. As far as single audit goes, everything was clean. We expressed an unmodified or clean opinion on compliance. Also, we did not identify any material weaknesses or significant deficiencies on major programs that we tested. And since I think I talked enough, I'm going to have Jess to cover the management advisory letter and the required auditor's communications for the next 2 or 3 slides.
Yep, I'm going to give Nicoletta a break here. So as Nicoletta was saying, there's kind of 3 levels of findings. There's material weaknesses, there's significant deficiencies, and then we have some just recommendations. So these are not anything that we thought would cause a material misstatement, but it's a recommendation that we see the town to kind of improve what they're doing. So we didn't actually have any new recommendations. The recommendations that are in this letter are all from prior years that are just have not been implemented yet. So I think everybody has the letter, right? So this is, it says prior year recommendations about midway through the first page. I'm going to kind of go through this, so I didn't know if anybody wants. So the first recommendation that we've had for several years here is on capital asset reporting. The capital assets are mainly kept on an Excel spreadsheet. I think over the years, we've recommended that they be put into a system, and I think maybe a few years ago, it started going into a system and then didn't get implemented fully. So now, with our discussions with management, which you can also see under the 2019 update for any of these comments, this is kind of where the town is with them. So the town has purchased Munis, and that includes a capital asset module, so we would assume once Munis is fully implemented, this comment will finally get out of this letter, and all the assets will go into the system. The second comment is on fraud risk assessments. Every day it's in the news, there's a lot of it going on, so we always like to keep this comment kind of in your face a little bit, just to keep everybody aware of how much fraud is out there. And the fraud risk assessment is designed to proactively identify fraud risks, pinpoint opportunities to reduce the cost of fraud and determine whether adequate fraud prevention exists, and to help create cost-effective fraud prevention. So this has been also in the letter for a few years. The update for this year is that a funding request was made during the fiscal year 20 budget, and it's been included in year 2, so fiscal 21 is when I think this might start happening. On the last page of the letter, the accounting procedures manual. Again, this is one that we make to several municipalities. It's always good to have all your procedures in one bound document or one electronic document in case anybody leaves or somebody has to come in and pick up the pieces. There are some processes right now for the town in a folder that everybody can access, but it's not all correlated into one place yet. And again, this is all going to change with the processes with the new Munis system, so this is kind of on hold until that system goes into place, and then a more formal procedures manual can be implemented. And finally, the positive pay system, and again, this comment, 2011, it's been in here since 2011, because it says during that audit. The system you have now Simsbury Bank has changed, originally didn't interface with Simsbury Bank. So that, again, hopefully will be solved with the Munis program being implemented, and positive pay can be put in place. So that's the management letter. Any comments on any questions on any of those comments?
I'd like to just make a comment, and that is to thank Amy for all of her work in getting us in compliance on all of these things and following up on your recommendations, some of which have been hanging out there for a pretty long time. So good work, Amy.
All right, so just going, there should be another letter that I think everybody has. So this one has significant audit matters right on the front page. So what this is as we do for our preliminary communication, which I believe you guys get in the form of a memo, we're required to communicate certain things in regards to our planning in the audit, and then at the end of the audit, we also have this communication. So again, I'm going to kind of paraphrase this letter. I'm not going to go through and read it to you, but under management is, like Nicoletta was saying, responsible for the selection and use of appropriate accounting policies. Those are all listed in note 1 of the financial statement, so if you have any questions on those, you can see them. There were no new accounting policies adopted this year, and we noted no transactions entered into by the government for which there was a lack of authoritative guidance or consensus, which is what Nicoletta had said earlier. Within the financial statements, there's always some accounting estimates. These estimates are based on management's knowledge and experience about past and current events and assumptions about the future. So listed on page 1 are some of these estimates. The net pension liability, which we've discussed a lot tonight, that's based on the actuarial evaluation using management's assumptions. The OPEB liability, again, is based on the actuarial evaluation, so we look at what the actuary has done to make sure it's reasonable and before putting all that stuff into the financials. Also, management's estimate of the useful lives of capital assets, that's used to calculate your depreciation, so that again is an estimate in financial statements. The allowance for doubtful accounts related to taxes receivable, that's based on historical data and current known information. If you know there's going to be a large taxpayer that's not going to pay, that may go into the allowance calculation. And finally, the estimate of the incurred but not reported claims, which is a liability in your internal service fund. That's based on the claims analysis done by an outside vendor that we look at again to make sure it seems reasonable. So we look at all of these estimates to make sure that nothing seems unreasonable to us before we give an opinion on the financial statements. As far as difficulties encountered in performing the audit, we didn't have any difficulties. Anything we request, we were given. We didn't have any corrected or uncorrected misstatements that management didn't. We did have some journal entries. They were not material amounts. If they were material, it would have come through as either a significant deficiency or a material weakness based on the size of the journal entry. Management made any of them. I know I looked at them before we came out, and they were all minor amounts. So those were all made by management. We didn't have any disagreements with management where they just said we were wrong in something we were suggesting or wrong in a journal entry that we were proposing. So there are no disagreements with management. Management for both the town and the Board of Ed does sign a representation letter at the end of the audit. That just says that they've given us, there's a lot in that. It's a pretty lengthy document, that they've given us access to everything. Any questions that we've had, they've answered. There's several things in there, but they do sign that to say that they, everything they gave us was truthful and they gave us everything we requested.
I just asked a question when in both the context for the town and for the Board of Ed, when you say management, who signs these representation letters? Maria and Amy?
I think you,
Both.
I think you both.
And do you sign,
Both of you both sign,
Yeah.
yeah.
and for the Board of Ed?
Superintendent and the business manager.
I'm sorry?
Superintendent and the business manager.
And the business manager.
This year was the.
All right.
Which I think here, yeah, I think the accountants.
And again, this is that's in compliance with the charter change that appointed you the chief executive officer of the town and Matt. So there's no board oversight or any other required sign off for these representations that you rely on.
Correct, because management has to basically affirm that they provided everything to us, they take responsibility of the financial statements and internal controls over financial statements.
Okay.
So basically, they take responsibility
All right.
for everything.
Thank you.
Just continuing on, there was no, management did not consult with any other independent accountants. For instance, if they didn't like something we were saying or how we were proposing something, they didn't shop around to other auditors or other accountants and say, what would you do in this situation? There was none of that. And as far as other findings and issues, I just went over the management letter that kind of sums up any other findings outside of what Nicoletta has already addressed. So I think that's my slides.
And very last slide, excuse me if I have a little cold. As upcoming GASB standards, I will not spend a lot of time with it. I just listed on that page for fiscal year 2020, there will be two GASB pronouncements that are going to be effective. 84 is the one fiduciary activities that is going to be applicable for the town. We are not aware of any majority equity interest of the town in any other entity, so we believe that that is not going to apply to the town, but fiduciary activities will apply. So basically, this statement is going to take a look of all the fiduciary activities and to make sure that they are reported correctly. Some changes might be done in the reporting. There's not going to be any more agency funds, but they might qualify either as a government fund or a newly created fund, custodial fund. We have prepared a comprehensive questionnaire for our clients. We'll go over with our clients, explain to them just to make sure that the GASB 84 requirements are properly implemented. So any fiduciary activities that the town has are properly reported in the CAFR. 2021, this is going to be a big one, statement 87 leases, which will require that not only the capital leases to be reported as a liability in the books, but even the operating leases if they are 12 months or higher. So it's important that the town and the Board of Education start looking at all the contracts and agreements that are in existence. So any contracts where the town is either lessee or lessor are inventoried, so when time comes to implement, the information is available. It seems like 2021 is far, but it is really not, because the information as of July 1, 2020, it would be needed when this statement is implemented, just so we know the beginning and the end and all that. We have had discussion with both the town and the Board of Education regarding this during our planning meetings. We'll continue having discussions again when the next planning meetings come, and we'll see where the town stands. I'm not sure if Amy wants to chime on this one, but it's coming. It's in the horizon. They will be included
But
in
other
there.
than that, we don't have any other major leases.
Yeah, but again, any new GASBs are applicable only for material items. So if you just have a small operating lease, maybe it's not a big deal. But if you have several small ones, they combined may become a big deal. So that's why we are saying inventory them, just to make sure, so you know that you have 10, 20, 15, or maybe you just have one, but at least you know what you have, and then you can make a determination, will it apply or not? Is it material enough to be included in financial statements or not?
And this also includes if the town is leasing like a piece of property. So it's
Yeah.
not just the ones you have, it might be something that you're the lessor.
Yeah.
So we need to know about those as well.
We have those.
Yeah, so you got to make an inventory of those. But
Yes.
in that case, you are going to have a receivable in your books as opposed to having a liability. Statement 89, accounting for interest costs before the end of the construction period, that's only applicable if you have, if the town has an enterprise fund and has issued debt while the construction period is going on. In the past, interest was allowed to be capitalized as part of the capital asset. Now it's going to be included only as a debt service expense, so it's not going to become part of the capital asset cost. For 2022, statement 91, conduit debt obligations, the town, I don't think is going to be applicable unless you are planning to issue debt on behalf of a third party. The existing pronouncement, conduit debt was, you could report it in your financial statements, or you can disclose it in the notes to financial statements, and 91 now made it clear that it's not going to be reported as your liability, but just going to be a footnote in the financial statement. So, but this is not going to apply to the town, so, but just more for your information and education. So, but the big one, 84, and then 87 the following year are coming up. Even though I say big one, it might not be big for your town, but it's going to be big for governments as a whole, all over the place. And the very last has my contact information, last page, and Jess's contact information. So that concludes what I wanted to cover today for this presentation, and if you have any more questions, I'm still here.
Lisa?
Can you speak to Gatsby 77? I know in the past the town hasn't done tax abatements, but they've started doing them. We have 2 outstanding, and I know Gatsby, I think it was Gatsby, talked about the...
77, you're correct.
Yeah, it's talked 77, talked about the limitations of actually their reporting, and they don't show the long-term gains, and they suggested putting some additional information in other parts of the CAFR. Do you have any thoughts on that and where those will be? Amy and Maria, I'm assuming those aren't in this cap, they'll hit in the next CAFR, is that right?
We gave them the abatement agreement.
Yeah, I think they hit the next.
They'll hit the next year.
They
So-
already have the agreements to report on them.
And is there a way to sort of talk about the long-term, some of the deficiencies that Gatsby points out in 77, they themselves point out some of the deficiencies?
Yeah, so the tax abatement is going to be just a disclosure, even also financial statements, basically to alert the readers of what contracts are there in existence and how much money from the tax revenue that the town would have been collected is foregoing. So let's say those numbers could be very small, could be $10,000, $20,000, $30,000. I know we have those agreements, but I don't recall the numbers of how much money the town is going to lose over every year based on the agreements. But basically, if the town has a good handle of all the contracts that are in existence out there, then that the disclosure, I believe, will be very informative to the readers of the financial statements of how much the town is letting go of the tax revenue that would have collected in interest of having those economic developments in the town for betterment of the town and for the future, for benefit of the future.
My last question is just on bond premium revenues. Where do you see those, how do towns spend those and where are those put? What are there best practices?
So the bond premiums, we see them in different places. There are towns that have a debt service fund, so that's where they keep the premiums, and then they supplement the debt payments every year. They kind of have like a schedule based on the interest payments of how much of the premium is going to go every year.
So it can reduce if they spread it out over 10 years or
Correct.
something?
Yeah, so, but they have to be recognized because based on modified accrual accounting, they have to be recognized as revenue on the year that you get them in the financial statements. So if all those, the revenue is recognized in the general fund, it's already in the fund balance, but then you can commit it for future use to match your interest payments for the life of that
Do
debt.
people just put it in the general fund?
We see general fund, debt service fund, capital project funds, it depends on how
So it
decision
could be
was made
used
by
to
the Board of Finance.
bulk up reserves or to lower,
To lower debt
payments?
payments in the future, yeah.
but there's no, are there any limitations on what it can be used for, I guess is what I'm asking.
If there's no limitation from the bond covenant from your bond document, then it's your body to decide on how the money is going to be used.
But there might be limitations in the bond contract?
Yes.
Okay.
So you have to read the bond document and have your bond counsel advise you on limitations.
And are there any best practices on what it should be used for, or,
The best practice is to cover the interest payments in the future.
and to spread it out over the term of the bond? Okay.
Wasn't there a discussion about what you could call that fund?
Yes,
Or what we cannot call that fund?
yes.
Right.
And I don't remember the discussion.
You can keep it in the general fund, you just
Right.
commit it for future use for debt payments or whatever the decision is made
It's all
at that point.
transferable from one fund to the other, so might as well
I think
just
the
be general
recommendation
fund.
was a mill rate stabilization
Oh, yeah,
fund.
yeah.
So,
Yeah, as long as when that particular bond is issued, there is no covenants related to it, then you can
Right.
decide. But the bond counsel will be the proper body to ask that question at the time of the bond issuance.
thank you. Anybody else?
Yeah, I have a couple specific questions that may not be possible for the ladies to respond to this, maybe someone from the Board of Ed could. But, on page 7 and page 9, I have specific questions. Page 7, under program expenses, when you look at the year 2018 versus 2019 for education, it looks like education expenses went down over $3 million, and I'm a little mystified by that.
So, included in the education line on that table is the on-behalf payment from the state of Connecticut for teachers' retirement and OPEB. Which is called either pension expense or OPEB expense, that number went significantly down in the current year. I don't know if you have a CAFR from the prior year, but those numbers for the current year are, anybody has it right here? So if you look at current year CAFR, the on-behalf payments from the state of Connecticut to town of Simsbury is the net of $12.4 million and $7.3 million, so it's about a net of $5 million that's added to the education line, so all the education expenses you have. And that number last year was probably another $5 million more. We are just trying to find the report so we can compare those numbers, but that's the main reason for that decrease. It's not that the Board of Education expenses really decreased by $3 million, is what goes in that number on accrual basis.
So it had something to do, it's hard to hear you from here, had something to do with OPEB?
No, the allocation from the state to the teacher's pension plan.
Oh,
So the on behalf payments from the state on behalf of the town of Simsbury retirees is reported as revenue and as expenditure. So the net is zero when it comes to the net position or fund balance, but if you compare year over year the numbers for the education, they'll be impacted by that change in the on behalf payment amount.
okay, and so does that explain also on page 9, on education line, where there was an $8 million variance from 2018 to 2019? Is that also related to that?
I'm sorry, I couldn't hear that. Which line?
On page 9 at the top, where the 18 was 24 and 19 is 16, basically.
Yes, yes, exactly.
I'll say yes without looking the numbers behind it, but yes, will be related.
See, it's similar to the, it's the same magnitude of the other change, Linda, that's right.
Yeah,
Yeah.
okay. All right, thank you. I looked at that and I was like, well, wait a minute.
Yeah, so, we got the numbers from last year, where 12.8 plus 1.3, so it'll be about $14 million, and this year was what did I say, it was 12 minus 4, right? About $8 million, so yes. So the difference is the change on the, on behalf payments from the state of Connecticut for the teachers and OPEB plans.
Okay, thank you.
Anything else?
Nope, that was it for me.
Thank you guys very much.
Thank you.
All right. We have now made it through number 5 on our agenda. All right. And we need to pick up the pace. But thank you guys very much. We really appreciate the presentations from our outside consultants. So now we have allocated an hour and a half for Derek to give us the school facilities long-range planning update and oral report.
At the risk of, repeating what everybody may have dug into or know, I would obviously ask anybody to interrupt or stop me with any questions, but, our last meeting for the facilities task force, the school facilities master plan and reconfiguration study, and please, Maria, you can interject at any point as well, was on January 30th. It was a rather lively meeting. It's certainly bigger than meetings in the past, and we did have some public, people from the public come in and watch, and it was also on SCTV as well. I'd point one to a couple things. The website, www.simsbury.k12.ct.us, facilities-study. That has a bulk, if not all of the information that you need to digest in terms of the most recent discussions about the school facilities, most importantly to the discussion. I would also publicly acknowledge that Jeff W., I don't want to torture his last name, at Tecton, there's been many cooks in the kitchen. Jeff's been very good at digesting and interpreting our input and putting something thoughtful in front of us. I would also point to the presentation that's online and the proposed milestone schedule, what kind of puts, all the dates out there in a thoughtful way in terms of what's coming up, whether it's the facilities task force meetings, Board of Education meetings, Board of Finance meetings, Selectmen meetings, and then, the community input sessions as well, really by neighborhood and district and school district. Then lastly, we've just recently published a survey that's been out there for, I guess, a couple, 3 weeks. How long is it? 3 weeks or so? 2 weeks. And the cutoff for filling out that survey, which is also online, is Friday of this week. There will be likely another survey, but it'll be very useful to get the feedback from this survey. It was thoughtfully put together, and I think the questions are pertinent and relative to what we're trying to figure out together. Just as a backdrop, Tecton, I want to say Tectron, with Mylome and McBroom, we're kind of tasked with going out and auditing our public school buildings, but also our public buildings in general, but the discussion has revolved mostly around our school building. And really just getting an idea of, where, the age of the buildings, the useful life of components, enrollment projections by Mylome and McBroom, best practices, educational environments, including class size for both students and teachers, not just students. And then trying to balance that with some of the cost figures that we've seen. It's in the tens of millions. In the aggregate, it's over 100, upwards of almost $200 million, over a 20-year plan, I would say. And we're trying to prioritize kind of cost and what buildings need what first. There's also discussions about changing the profile of how we educate, meaning will we have K through 4, a new 5-6 school, and with the 7-8 and then the high school, or do we want to maintain the way that it's currently operated at K through 6, 7, 8, and 9 through 12? A K through 5 and 6, 7, 8 has been proposed as well, and all of these have different cost implications. Likewise, whether we build as new or renovate these buildings also has cost implications. It also has, implications in terms of what the state will provide or reimburse us as well. But at the end of the day, it really, it's something that we have to think about without, I think, in terms of, most importantly, the discussion is revolved around the environment, the educational environment. And then I look at it also as kind of comparing ourselves with other towns in the valley and making sure that our rating in general stands with our peers. And really what Jeff has done, he hasn't necessarily said this is what you should do, but he puts these projects in context of what maybe our other peers are doing. Farmington, for example, went to a 5-6 format years ago. Similarly, I think South Windsor has done a lot with their public buildings as well. Lastly, I'll just say, and I'm willing to take any questions as a representative of the Board of Finance at this meeting. I would say that, you'll see on the proposed milestone schedule that there's no meetings with Tecton for the Board of Finance, and I mentioned at the end of our last meeting to Maria and to Matt Curtis that I thought, as well as Jeff W., that I thought it was very important that he or they should come in front of the Board of Finance to kind of give an update as well. As he, will be at Board of Ed meetings, Board of Selectmen meetings, I thought it was important for him to get in front of us in person, not just by updating the website with materials, because it can get confusing and there are a lot of iterations of what we could do.
Thank you, that makes sense.
Yeah, I'm just trying to think. And then, so I think another important point is that the next public forum will be on March 4th at 7 p.m. At the Simsbury High School auditorium. I expect it to be well attended. And I think a lot was kind of opened up at the first public hearing and really has made this a much more topic of interest, I'll say. I would say that our policy has been to be transparent The information as evidenced or as supported by the 2 or 3 people that stood up on behalf of other schools besides Terriffill, because it was mostly a Terriffill public forum that night, did acknowledge that the information has been out there. So now I think people are paying a little bit more attention. And then I would encourage the public to find the survey also online and fill it out. And so we have, good tangible feedback to, base our suggestions, I would say. So I'd any questions, happy to answer.
I guess one of my questions is, for me, the study or the analysis didn't actually address the fundamental issue with the town and the cost associated with schools. To me, we have too many elementary schools that are in the system, and we're really not addressing the issue of being able to, if an additional student is put in at Latimer Lane, and one goes in over at Terriffill, we have to add the teachers. So from my perspective, the study didn't address the fundamental issue of the costs associated with it, and also it doesn't feel like it addressed the whole town. It was just only from a school perspective.
Yeah, my understanding is that.
And it's not directed at you, it's just.
Oh, no,
a general
just, no, point taken. I do understand in discussing with Lisa that there is an actual public buildings, non-school public buildings audit going on as well. I'm actually haven't, I don't know who's undertaking that, if there's an RFP.
Maria and Tom
or-
Roy.
Is it with Tecton also, or no?
We are working with Tecton on the proposal. We thought that there would definitely be some efficiencies and very good reasons to work with the same consultant, so we're comparing apples to apples with our infrastructure. It was a capital project that was previously approved, and Tom Roy and his team will be heading that project up for us.
I mean, certainly in terms of redistricting and maybe moving people from otherwise their neighborhood school to another neighborhood to go to school, the cost of that, I don't know if too much of that was really dug into. We did talk quite a bit about redistricting as an option. We talked about status quo as an option, which really isn't status quo because it talks about modular school classrooms, which we've done before as an option, and it revolves around again the concern about a wave of enrollment that's coming through, and I also want to say that I did pass on. Unfortunately, I couldn't make the last Board of Finance meeting, but I did pass on the collective questions to Tecton and the broader Facilities Task Force group, and I would expect that we could have a discussion with Jeff about that. I think a couple of them could be difficult to answer directly, but certainly it could be a conversation starter. And then, just kind of to acknowledge your point, Kevin, people are very connected to their neighborhood schools. So, we've discussed the reduction in the number of schools, and that's when you start getting the most public input, and we expect the same to happen probably at the next meeting as well. I won't opine, but if you take Mylone and McBroom's numbers at face value, we are going to see a significant number of kids above where the enrollment now going through an aged school system.
Do you know how many?
I don't have the number in front of me, but I can look it up.
I was just
Yeah.
curious, because the CAFR shows we're down 800 students since 2010.
Right.
So
Right.
is it within the range of
Yeah,
height or a
yeah,
portion of it?
Yeah, we have conversations. I mean, even the people on the task force themselves went through the public school systems when there were many more kids going through. So, I'd have to look at the.
That would be
Mylone
helpful
number.
to see that information, or maybe when Tectron comes to us, that would be helpful to look at
Thank you,
that.
Derek.
Yeah, Derek, I know one of my questions last time was also about, enrollment numbers, and particularly if it's roughly 300 additional students that are being predicted by Tecton. And, in the last 15 years, we've had 1,000 more students. Of course, we also had all kinds of classrooms, temporary classrooms and stuff too. So I'm glad to hear you're looking at all of those options. But to me, the big question is looking at the bigger demographics of baby booms, baby boomlets, baby busts, sort of the larger things that are going on. Are we expecting that 300 is the peak or 300 is the beginning of a trend? Because I think the answers to what do you do are vastly different depending upon whether it's a peak or the beginning of a trend. I don't want to see us spend millions upon millions of dollars to build additional capacity that's then going to be very quickly empty if it's a peak that's sort of, a flash in the pan. Temporary solutions are what we should do if it's a temporary increase in population, and I haven't been able to get that information from anybody.
Okay. No, understood. If it's, it makes sense to me that if we're talking about adjusting for 1 or 2 years, that makes sense. I also just put it in context of when our buildings, the environment that are, and again, environment is a squishy word, I would say, just the age and useful life of the buildings as well. I think we have to also contemplate, to Kevin's point, not just what the cost is of either redistricting or rebuilding or redeveloping, but what the ongoing costs or increased costs are of, maintaining the buildings as is. And if there are any efficiencies going forward.
I agree. That's a really critical thing, and that was on my list also, is to have a better sense of the cost benefit. If we have to spend $20 million to save $50,000 a year, it might not be worth it.
Right.
But if you're spending $20 million to save $2 million a year, well, then a 10-year payback is worth doing. And I don't think we have a good sense of the context of that. A couple of other comments. One is I was disappointed with the wording of a lot of the questions on the survey that I found to be kind of leading or didn't give people the kind of option for an answer that I would have wanted to answer. I hope that there will be another survey and that the Board of Finance has some input into, well, actually, more importantly, I hope that somebody hires a real company that specializes in surveys, because it's a science how you do this. And some of you weren't on the board when we did this before, but when we had the senior center being proposed for $8 million or $12 million, we did a survey that was designed to test people's tolerance for tax increases and to get a sense of how much of a tax increase did they have tolerance for. And there really isn't any of that kind of information that will be evoked by the current survey. And I think that we really need to give people the opportunity to not only say, yes, I want all these wonderful shiny objects, but, well, I maybe don't want them at that price. And that's a critical thing to understand.
Yeah, I would acknowledge that there were certainly ways that I would have asked questions differently, and I thought that they were leading as well. When there were 30 people or so in the facilities task force meeting, each one of us had our own thoughts on how things should be worded.
Right.
We actually thought at length about reducing the number of questions, but at the end of the day, thought it was best to just kind of see what we got back initially, knowing that there would be another one. And it's certainly within the purview of Tectron. They've done it before, the surveys. It may not be as scientific as maybe a business related solely to survey taking. But, talking with Maria at the end of the meeting on the 30th made a good point about putting an example in there about, if your home costs X, this would likely be your increase in taxes for X, Y, or Z proposal. Would you be, to put it in context, what are your thoughts on, absorbing this tax increase year over year? So there are these discussions going on, and I completely understand your thoughts on the way the questions were asked.
I just want to say one last thing, and that is I had the opportunity to go to one of the neighborhood meetings at one of the schools, and I was at the prior forum as well, but I do want to acknowledge the tremendous amount of work that the task force did and the tremendous challenges for the Board of Ed. Listening to the parents, excuse me, you really realize and have an appreciation for the fact that there's no way you can come up with a solution that's going to make everybody happy.
Right.
And so I just want to acknowledge that I know everybody is doing the best they can trying to come up with something. We'll all have different opinions, but it's a very tough challenge that they've got.
Yeah, so, and I would encourage anybody, whether you're watching on TV or in the room, to email me with any additional questions. And, and I'll be in touch with Jeff on trying to set up a date to get in front of our board here.
Yeah. Lisa?
Two things. First of all, thank you for your efforts. I appreciate it. It's been a little bit of a hot seat there. Interestingly, when I talked to both Derek, Jeff Tyndall, and Matt, the research is not clear as to what's best educationally. Should it be 5, 6, 4, 6? So it's all over the place. There's no best practice and what's the best. So that was an interesting sort of, we're not being driven by research. This is the best structure for kids because the research is all over the place. Second point, I do want to reiterate what Linda said. I know when Farmington was considering doing school construction, they used Pew, which had a margin of error, and we used Great Blue, which also had a margin of error. And Maria, to your point, I don't know if you've looked at the 2015 study, but it does literally take the median household and say for $12 million, this would translate to $150 a year increase in taxes. So they did do it that way, and you could frame some of those questions in a similar manner, but I think that's exactly right. But I would encourage you to use a company that has statistically reliable testing that they do. And then the last question is really for Rob and Amy, who are going to work on the chart that Rob started. And I don't know if that's ready or when that will be ready.
No, it's not, but it's one of the things that I wanted to sort of wrap up by saying that I think these are all very important comments and charges that we would ask you to take back to the task force, Derek. And I would echo what Kevin said, which is that one of the things that I think we need to flesh out or be sure is part of this is the benefit. And that's primarily from an operating standpoint, because there is a more efficient size of elementary school than what we currently employ, in my pretty simplistic view. And it has, but that's counter to the culture of a town that prides itself on neighborhood schools. So there's going to have to be change here to achieve one or the other. And if we're going to continue to have this, there's a cost associated with that. So I think all of the ideas are good that are being thrown around by Tecton. I think my initial take on the report was it was a little bit too much about the buildings and not enough about the education, the delivery, and the cost benefits.
Totally agree.
Yeah, and so then
When you talk about cost and benefit, are you talking benefit from an operational dollar standpoint, or can they, because a lot of what we talk about is carbon neutral, we talk about,
I think all of that's great, but I think at the fundamental level, it's the quality of the education is, as Lisa says, there is no perfect blueprint for these things handled, but I would want to be sure that if we invest this much money over this long a period of time, that there is some support, theoretical support
Return on
for
investment.
increasing quality of education or quality of delivery or whatever. I would also say, though, that there should be some benefit, cost benefit of fewer facilities, fewer administrators, better, more optimal class size, won't go into the tedium of, if you only have 2 second grades and you bring in 3 more kids, in some cases, that can mean a third classroom, and that's not efficient.
Yep.
And we've been unwilling to do some of the hard things, which is redistrict or soft districts or split classes. And so that's what I was hoping, and I think we were hoping as a board when we commissioned this study, was that we would get some of that back. And I think there's some of that in here. I think we focused more so far, and I hope that these conversations will continue. And I've been talking to Matt about it as well, so that the feedback goes back. Then the last thing is the affordability of it, which goes right into the cost of debt, cost of the buildings, how many buildings, when do we borrow, how much support do we get from the state, what's the zero-line budgeting cost, because there is a cost inherent in fixing these buildings that part of the report was that they're not ADA compliant, or they're inefficient, or they're old, or they need this or need that. So I'm really trying to encourage that work to be done while everyone keeps an open mind as we move to an honest community debate about what we want Simsbury 2035 educational delivery system to look like. Because if we do nothing, or we get hung up on it's too expensive, or we don't want to close any schools, then we're still going to have to pay money, and we may not have benefited in any way from all of this effort. So I'm hoping that people listening in the audience, and we've got to get everybody involved. And when I mean everybody, the stakeholders here are students and teachers, students and parents, the PTOs, the teachers, obviously, and the educators, and the taxpayers, and what we want our town over time. And there will be demographic changes that are already happening, and we see it. But we've got to get the dialogue to be broad enough and open-minded enough that we can move from the strict districts we have today. We've already made one move. I guess some of the new buildings are already being designated to not go to the most logical geographic school, because that school is already over capacity. So those kind of things we have to be willing to do, and that was the point of all of this, and I hope that we can keep going forward and make these discussions head towards some sort of consensus.
Yeah, I agree. I mean, when you look at it as a whole, it can be overwhelming. These discussions, there are people on the facilities task force that were part of these discussions a decade ago, if not longer. So I encourage people to look at it more from a priority standpoint. In other words, what needs the most attention today? What might we be able to wait 2 years to do, and then 2 years after that? Because it's, the scope is quite large when you look at it in its entirety, so.
The first initial impact, I believe, is not to the 23-24 school year if we started today.
Right.
But nonetheless, there's a lot of work to be done to get to a starting point from where we sit today.
That was clear. At the open meeting, it struck me that, including Board of Education members, were struck at how much the report was technical, financial, and on facilities, and seemed to clearly miss the sense of community, diversity, and quality of education that was to be delivered. And there was a clash and a lot of emotions there. And going forward, we're going to need to talk about that. I was also struck by former chairman of the Board of Finance, who pointed out that when we had this kind of a presentation made before, the Board of Finance just turned it down because it was too expensive. At which point afterward, people were wondering, what has the Board of Finance been involved in? I pointed out, it's new to me, but I very much welcome your suggestion they come and talk to us.
Yeah, I agree.
Because
completely.
Not only do we need to form the consensus that you're talking about, technically, financially, but also quality of education and community and diversity, but also, how do we pay for all this? Because there was also a reaction to that. It seemed to be too much of a shock for the system coming out of that meeting, and I think that's something we're not going to need to be involved in early and very deeply.
All right,
Understood, thanks.
marching orders? Got it. Good. All right, let's move on. Draft annual town report. Here's an agenda item we can all get behind.
Let the record show that I have to excuse myself. Thank you.
So, thanks, Derek.
Yep.
So Derek's leaving the building. We still have a quorum,
Kids to pick up.
right? Okay.
Yeah, Linda, don't get off the phone.
Yeah, Linda's, keep your head above the pillow. All right, do we need to take, we
Am I
don't,
on Derek's phone? Am I going in the car with Derek?
no. All right, so,
Linda.
do we need to take any action? Is there any discussion about the draft annual town report?
My only thing is that I think it is important for the chairs of the three committees to do a letter. And to the extent, if you can, to list all the boards and commissions, because these people are giving of their time, hundreds of hours, and it's just nice to recognize them. If you could just list the people who serve at the back, that would just be a lovely thing. They can show it to their grandma.
Costs nothing because it's all electronic anyway.
Right, and it's just a kindness and a recognition of service.
Pictures are not required.
Pictures are not required, although for the chairs of the committees, or maybe the boards, that would be nice, actually.
Okay, so let's move forward with this project. Great. Next is the draft debt management policy. Now, I really hadn't hoped that we'd start this at 8 o'clock, but I do feel like because how long we've worked on this, it's important that we try to bring this to a conclusion. I'll give just a brief tee-up. I know Lisa has a few views. This is a result of our attempt to update the Board of Finance debt policy and subsequent discussions that led to a review of the charter, which indicates that the actual issuance of debt is the purview of the Board of Selectmen, but having levels of debt and debt service is absolutely the responsibility of the Board of Finance. After a lot of discussion at both the Board of Selectmen and the Board of Finance, we decided to take and make one policy, which required that we have a work group, which Lisa and I represented the Board of Finance, and Sean Askham and Chris Peterson represented the Board of Selectmen. And at that work group, we came to a compromise, and that's what's being presented tonight for approval. Now, Lisa has a few comments.
First of all, I do want to thank everyone who worked on it. Amy, thank you for your assistance, Melissa, Maria, in terms of staff, and of course, the two boards. I do appreciate that. And I did put together, I think everyone knows I was probably most passionate about this. And the reason why is because while we're talking about a debt policy tonight, we're really talking about the structure of government roles and responsibilities and our fiduciary duties in law and in policy. And that's why it's actually, I know it's very wonky, but it's actually fairly significant. The development of debt policy for the town of Simsbury has always been the sole purview of the Board of Finance. Through the charter, the people of Simsbury have given the power of the purse to the Board of Finance as the primary budget-making authority for the town of Simsbury. This board adopts and forwards budgets to referendum. In that capacity, the Board of Finance has always exercised its fiduciary duty in developing financial policies for the town of Simsbury. I will be voting for the proposed debt policy, in case there were folks out there who were wondering, because it's in the best interest of the town to have one debt policy. And this policy, consensus policy, and in some ways a compromise policy, preserves the Board of Finance's role as the budget-making authority. The Board of Finance retains its authority to set overall debt service as a percentage of operating costs, bond terms, and line item authority on the Board of Selectmen and capital budgets, among other responsibilities enumerated in the policy, town charter, and consistent with state law. A principal purpose of the Board of Finance is to serve as a check on spending, including the long-term accumulation of debt to be paid by future residents. Our system of government is designed with checks and balances to avoid a fox guarding the henhouse situation. This policy was primarily researched and written by members of the Board of Finance, and I thank all of you now for that. It reflects legal standards and best practices of GFOA and GASB. In supporting this policy, I do not, however, concede that the Board of Selectmen approval is a necessary condition for its adoption. Although I do acknowledge and recognize Eric, the Board of Selectmen has approved the policy as written. I wanted to thank Mr. Askham for publicly stating at the subcommittee level and the Board of Selectmen level that he did not view this document as a change in past practice or responsibilities. I agree, and it is for this reason that I will be voting for the policy. Today, we are fortunate to have excellent public servants on boards of selectmen and education that work collaboratively with the Board of Finance. But I think all of you can imagine a time in the future with different elected officials when this might not be the case, where having important checks is essential. One need look no further than the state of Connecticut to see what could happen when there is no independent check. There, in pursuit of short-term and short-sighted savings, pensions were underfunded for 70 years. Debt amassed, leaving large payments to future generations, and unreasonable investment assumptions were used that did not reflect the promises made to teachers and government employees. So I acknowledge and thank Rob for your support and efforts and work on this. Sean Askham, Chris Peterson, Maria, who just walked in, Melissa Appleby, Amy Merriweather for their efforts and time in working on this policy, and of course the members of this board. As an aside, and I feel obligated to mention this, I acknowledge and thank Representative Hampton, former State Representative Linda Schofield, and Kevin Wickos for their past and continued work on fiscal discipline at the Capitol. I recognize that I said some harsh words there, but our representatives have served the town well with their fiscal responsibility advocacy. And I just wanted to make mention that we will be inviting Representative Hampton and Kevin Wickos to give an update on the state budget in our next meeting. And with that, I will be supporting this budget, this policy.
Is there any discussion about this? I guess we need a motion to adopt this debt policy.
Just one question.
So moved.
So let me ask a question. So we used to just have a general guideline of funding over 10 years. Has that changed?
We have always done 10-year bonding, and that stayed the same. When we did the initial draft that you guys looked at when we thought it was just our policy, we said that, well, sometimes for big projects over, we debated what that number should be, but I think we settled on 20 million. We do sometimes do longer debt, but that's always subject to approval of the Board of Finance budget referendum, like Henry James and the high school were 15-year bonds. So it does give the flexibility to do that. We say we use 10-year bonds, and if we're going to do more, we can if it's over 20 million and this board approves it. So that's how that was resolved.
Okay.
But 10-year bonding, yes.
So we've done 10-year bondings, but only in special circumstances. But this allows for 15-year bonding for what dollar value?
20 million.
20 million?
And so generally what we do is you do the high school 15-year bonds, that drops off, and then we do our next big project, 15-year bonds, that drops off, and then which is why the proposal of the facilities management is significant, because that will change that history. And so that's why we're going to have to really look at affordability, because it's a different approach, not going every 15 years, they want to go every 5. And so we'll have to look at affordability. And with 15-year bonding. So that will be a significant change from this, past practices. Not from our policy, but from how we've timed it.
So we have a motion. We need a second.
I'll second it.
All right. Any further discussion? So all in favor say aye.
Aye.
Aye. Linda?
Sorry, Ken, give me that.
Yeah.
Yep, aye.
All right.
I'm just going to abstain.
So Kevin abstains. All right. So it does pass with 4 votes for. All right. All right. Great. All right, next, Board of Education Budget Status Report.
So this is the most recent budget status report that was reported out to the Board of Education on January 28th. Just a quick overview of their revenues. In early January, they were able to get final state and federal grant award notices. So this just gives us some good numbers to go into, to work through year-end projections with. The only one that is still preliminary is the excess cost grant projection. We will expect finalized awards on the excess cost grant in late April. The ECS entitlement, we budget about $6,126,000. We're expected to receive $6,129,000, so very modest increase of about $3,700. Moving on to the general fund expenditures, I will draw your attention to the last two columns on the page where you have your fiscal year 20% spend compared to your fiscal year 19% spend. And if you go all the way to the bottom of the page, you can see that fiscal year 20 is at 45.88%, while fiscal year 19 for the same period is 45.18%. So overall in line with prior year.
And Amy, is that the first 6 months, or is that just the first few months of school, like September, October, November, December, when there's actually kids there?
That's the first 6 months, so July through December.
July through December, Linda.
Yeah, got that. Okay, I'm thinking the expenses are a little, but that makes sense. Okay.
Yep. So just a couple areas of highlight under the general control. There is a slight increase compared to the same time last year due to some staff retirements. They had payouts related to those retirements, and then some anticipated replacements in the central office. Due to the medical leave, there's expected to be some coverage for that person that's out. There is some discussion about possibly using some of the non-lapsing funds to cover some of these costs. But as they work through the budget and the final year-end projections, they'll be able to know if they need to use any of that non-lapsing. We can report back out on that in March during the next budget status report. Under the insurance and pension, during the fiscal year 20 budget process, dear Lord, they projected to use about $300,000 of non-lapsing funds to offset the increase in the health insurance costs. But right now, they're projecting to only have to use about $150,000 of that non-lapsing fund. So some good news there. And then the out-of-district tuition, this is the major cost driver in this year compared to the same time last year. You can see we're at 79.12% compared to 55.89%. There was a slight increase in the number of out-of-district students. So the number of out-of-district students increased by 2 students. However, the reimbursement eligible students decreased by 1 student. So theoretically, you would think that the cost would go down. However, the cost for the fewer students is actually higher. So these fewer students are incurring more services and therefore higher expenditures. So some good news associated with that is that with the increased costs, we are expected to receive an increased reimbursement via the excess cost grant. So that's all I have for highlights on that, if you have any questions.
Any questions for Amy? Okay, great. Moving on, Board of Education, we just did that. Recommended transfer to capital non-recurring fund from the town clerk LoCIP fund for vault update.
Yes. So back in April 2019, the board approved a transfer of $27,700 from the town clerk LoCIP fund to fund the flooring replacement in the town vault, in addition to some high-density shelving in the planning building department. So the high-density shelving was received by the planning and the building department. The town clerk really liked it for the vault. So the carpet is expected to go in during February. She would really like to get the high-density shelving as well. So they would like to increase the scope of the project to include the high-density shelving. And so therefore, they're requesting an additional $25,000 transfer from the town clerk LoCIP fund to complete the increase in the scope. So if the $25,000 transfer is approved, that'll leave a fund balance in the town clerk LoCIP fund of about $47,725. So still pretty healthy fund balance.
So moved.
And so we do need to move this, so it's been moved. Anybody's
Second.
seconded by Mr. Prell. You have any comments, questions?
I have a question. Last month, we had a proposal for another, and I forget what it was. Sorry, my brain's a little fuzzy. And we decided not to do that. So
That was the boiler, yeah, the boiler for the ice rink,
Yeah.
yeah.
That was,
We sort of erred on the side of, let's do everything at once at the end of the year because there'll be pluses and minuses, some of which cancel each other out. So my question is, in this case, is there a reason that we can't do the same and just leave it till the end of the year? Do they not have, is there not a way to pay for this with other funds and then settle it all out at the end of the year?
So they can pay for it with other funds at the end of the year if you wanted to wait for year-end transfers, but we have the money available in the town clerk LoCIP fund now, and that fund has to be used for specific reasons, which this would qualify under those circumstances. And then in addition to that, we have the flooring going in February. So in order to just do the project all at once and not inconvenience Public Works a second time, they're asking to be able to do it now.
So the circumstances are slightly different because there's a specific fund that has these funds in it.
for this purpose.
Right.
For this purpose, that's the
Okay.
difference, yeah.
I understand.
All right, so it's been moved and seconded. All in favor, say aye.
Aye.
Aye. Linda?
Aye.
All right, so
Yes,
that's,
I
all
said aye.
right, great. No, I got you. All right, so that passes. Finance Director's report.
All right, so super quick report. Here's your updated list of grants and donations through the February 10th, 2020 meeting. Nothing major to report there. Defined contribution and deferred compensation RFQ update, like Tyler said, they will be presenting to us, March 23rd. They'll be presenting all of their responses and the bid results to the town staff, and I believe some members of the retirement plan subcommittee, so we can start going through and see who we want to invite to come in for an interview. On the fiscal year 20 bond issuance, I think the last time we met, we were waiting, we had just had our bond rating call, and we were waiting to see what the rating was going to be. We did get our official rating, and we did maintain the AAA bond rating status. And because of that, when we went out to issue bonds for the Henry James project, we were able to attain a true interest cost of 1.56% over the 15-year bond period. And then the first debt payment is expected to be due in August 2020, which is fiscal year 21, so there'd be no impact to the fiscal year 20 budget.
And bond premium on that?
Yes, there was $1,021,000 bond premium on that.
And that goes into the general fund until we move it elsewhere?
Correct.
And that will be a decision during the budget process.
Yeah.
Right. Right.
And then Town Ag Road, we're still checks in the mail?
Right, so we haven't heard anything that we're not getting it. Everything, the governor released a budget which shows an estimated fiscal year 20 contribution. So everything points that we're still getting the money, but we haven't received it. We typically receive it by February. So just to give you a heads up that we normally have it by now and we don't, but it's still coming.
Okay, thank you. And then next item is the approval of minutes. I will note that Mr. House has made some minor edits to the discussion about how our board is made up and party representation. The minutes indicated that we had said that there can't be any caucuses, but the fact of the matter is that the members can caucus, we just can't have an informal meeting.
Right.
And so, I think these changes make that clear. And then Linda had asked that some additional items be included in the minutes in the area,
6.
where is it?
6.
Number 6.
Yes.
Linda made a number of requests for information. Oh, actually, you're on the phone, Linda. I'll let you explain what you asked for.
No, that's fine, thank you. No, just, I wanted, I had enumerated a number of data requests for Amy and the Board of Ed to respond to us with, and I just wanted to include those in the minutes. so that it's actually documented specifically what we asked.
Did you get it?
Yes, okay.
So Karen has those, we'll make those changes, and with those changes, I would move that we adopt these minutes as amended.
So moved.
Second.
All in favor, say aye.
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 All right, great. Okay, communications, building department revenue report. These will just be included in our package on a regular basis, so we can see how we're doing from both revenue and maybe if there's some big money in there, figure out what's coming down the pike. So that's all good. And with that,
So moved.
Mr. Prohl moves and Mr. House seconds that we adjourn at 8:18. Not a record.
We've done longer.
Yay. Linda, get some rest, get better.